All right, so as we get started today, a few administrative announcements. During the last class, or two classes ago, excuse me, Mike Gabali, who used to run investor relations at Lockheed Martin and is one of their senior finance people in one of their divisions, was here. We recorded him. That recording was posted on Canvas earlier today and is available for you to watch. On Wednesday, CSX is going to be here with one of their VPs of finance, basically talking through the rail industry and the rail peers. So they're going to be coming to the 2 p.m. section, which again, you're welcome to come and see, or again, it'll be recorded and posted online for you to be able to view at a later date. Okay, so those will be our next corporate presentations. So Wednesday, on the logistics side, is going to be a Bloomberg lab assignment day, except during your class, we're going to actually have a lecture, which is going to be recorded for the other classes. So basically, you'll have to do the lab, but you probably won't have time to do it in class on Wednesday. So you'll either do it in the morning if you want to do it with the other classes, or you'll have Thursday to do it. Okay? But basically, there's going to be a Bloomberg lab assignment. It'll be handed out on Wednesday. That will be due essentially on Thursday, because like I said, there's going to be a lecture during this class on Wednesday. So I wanted to let you know about that. All right. In addition, the midterm exam is 1 week from today, part 1. And then part 2 of the midterm exam is next Wednesday. So the midterm exam will be open book, open notes, open computer, right? So you don't have to do cheat sheets or anything like that. Now there's no collaboration. It's an individual midterm. It's not a group midterm. So you have to work on it individually. But nonetheless, it will be a 2-part exam. Again, it's going to be part A, I already told you this, is going to be just an economic statement conversion. So very similar to your homework last week. And I'll give another practice example this week. But basically, part A is literally just convert the statements. That's part A of the midterm. Part B of the midterm will be a series of multiple choice and short answer questions that assess your understanding of what we've been talking about this semester. Okay? Each part of the midterm is worth 7.5% of your semester grade. Now, if you took the BAT, you can use that against one of those 2 parts of the midterm. So it gives you a couple choices. So choice number 1 is you could skip part A or B and just get 7.5%. Or you could take part A and part B, and if one of your scores is lower, then that would be replaced with the 7.5 points. Okay, so let's say you take part A, you get a 7, take part B, you get a 5, then we would take part B, move it up to 7.5, you'd still keep your 7 on part A. So it's your choice whether you want to take both parts or whether you want to take one of the 2 parts, assuming you took the BAT. Question?
Yeah, part B on Wednesday, are the questions going to refer to what we did on Monday or to the topic?
No, anything, part B will be anything that's in the book, or anything in the lecture notes, or anything we covered in class is fair game for part B. Okay. All right. Other questions? Yes.
Are you going to go to the homework at all?
Briefly. Briefly today, and a little bit more time on Wednesday. That's what Wednesday's lecture is going to be about. Let's go through that in more detail. But basically, we are going to cover a little bit about the homework today. All right. So what I'm leaning towards, because I don't see the need to just stand here and watch you take the exam for an hour and 20 minutes next Monday, is to allow you to take it as, to some degree, a take-home exam. Now, basically what will happen is you'll take it on Canvas, and you'll take it with a timer. So you'll have the same amount of time to take it as if you took it in class. So if you want to come in the room and take it, you're welcome to do it. But if you want to do it, the comfort of your living room, of your apartment, you can do it there too. So, but nonetheless, you'll have to take part A on Monday. You'll have to take part B on Wednesday of next week. And you'll take it through Canvas in either case, right? But I will allow it to be taken out of class. So you don't have to physically show up on Monday to do it. Right? But again, it's an individual exam and you're subject to the honor code. Okay. So, with that in mind, one of your homework assignments homework 3 was to convert the economic statements. And under the files section of Canvas, I posted the solution to the conversion excuse me, of the economic statements. And in Excel, you can see the 3 tabs with the answers accordingly. Okay, so that is there and available to you. By the way, if you can do this, this is very similar to what Part A of the midterm is going to look like. Okay, it's going to be just like this homework. So what I'm going to do is I'm going to put up another practice problem today. And if you want to practice on that between now and Wednesday, we can talk about that on Wednesday as well. Okay, so just a little bit of repetition in the economic statement conversion. But obviously, here is the solution. And based on the solution, you can ask individual questions. Yes?
When you say similar, do you mean like the accounts will be the same, or?
Like this, these accounts will be the same, plus maybe a few new accounts. But otherwise, similar format of the statements.
Will they be numbered for us?
They'll be numbered just like this. It'll look almost just like this, just a few more accounts. Yes?
So for the CFI statement,
Mm-hmm.
when it's the other long-term non-operating liabilities,
Mm-hmm.
if we have long-term assets, do we do the change in assets and then net it with the change in liabilities?
The easier way, you could do it one of 2 ways, which is you could do it that way, or I think the easier way is just to come up with an overall net amount. So take all the operating assets that are long-term, the operating liabilities that are long-term, and then just net them out. That was the shortcut I gave you, by the way, for figuring out the change in invested capital plus PP&E, or plus depreciation, is basically how I got you to do gross investment. Similar process. So if you want to do it granularly, you can, and then just net them together, or you can do it netted together and then look at the change in the net. They'll both get you the same answer, whichever way is easier for you to think about. Okay. All right. So this, like I said, this solution is posted. If you have any specific questions after looking at the solution, we'll cover those during Wednesday's class. In addition, I posted this file, homework, or September 24th. This was last week's Bloomberg Lab assignment for McDonald's and Starbucks. So the idea was we were using the key value drivers equation, and then we wanted to say, using the key value drivers equation, can we estimate the long-term growth rate that the market must be using to get the forward PE for both of the companies? So essentially, what you had to do on the homework assignment is, 1, use the key value driver equation. Now, here's the thing. The key value driver equation basically is a growing perpetuity. All right? And so what we're doing is we're using a growing perpetuity on the free cash flow to basically value the operating value of the firm. Except what we did in the homework assignment is we actually used the value of the equity cash flows. So the free cash flow is the cash flow to the debt and the equity holders. Okay, that's why it goes into the enterprise value of the firm. But in this case, if we look at a pure price to earnings multiple, it's literally the earnings that go to the shareholders as the price I pay for those earnings. So that's basically just the equity cash flow. So in the dividend discount model that you've learned in previous classes, you actually did a version of this. Because when you did the dividend discount model, you forecasted out the equity cash flows, you forecasted the growth in the dividend, and you forecasted the discount rate, the cost of the equity to discount that. That's what I had you basically do here. So you can use the exact same formula, the rearranged growing perpetuity, to forecast equity cash flows rather than debt and equity cash flows. The difference is no PAT or no PLAT becomes net income, which is cash just to the shareholders. Return on invested capital becomes ROE, just the return on the equity, so the return on the debt and the equity. And we don't discount at the WACC, which is the discount rate for the debt and equity combined. We just discount the equity cash flows at a discounted cost of equity. So what we're then solving for is a growth in essentially earnings per share. It's growth in equity cash flow. So same process, slightly different numbers. So the idea is the forward PE for McDonald's and Starbucks was a little over 16 for McDonald's and 23.6 at Starbucks, back solving into the G that got us this should have gotten you about a 1.35% plus or minus a half a percent, or plus or minus 0.05%, plus or minus 0.5%. So I'd accept a range of 1.3 to 1.4% as an answer. And then Starbucks is around 6 to 6.2% as a range for an answer. But the point is, McDonald's is growing closer to 1.3, 1.4% long term. Starbucks is expected to grow much faster at 6 to 6.2% long term. They basically have similar returns on equity. The difference is McDonald's has a lower price to earnings ratio because they're not growing as fast. So I'm growing the same great return at a lower rate. People don't pay as much for that. The opposite is true for Starbucks. So that's what I wanted you to kind of see is playing out in the real world, and to show you that we can use the key value driver formula to help us explain that. Okay? So that was really the homework. Obviously, you were getting the data, and I posted all the screenshots as well off of the EEO screen. This is where you got the forward PE. This is also where you got the net income adjusted forecast. And if you make that smaller, this is where you also got the expected return on equities for the next 3 years. We just took the average. But again, it was really just practice getting data out of Bloomberg and then applying it to our formulas. So that's what your next Bloomberg lab assignment is going to be this coming Wednesday and Thursday, is doing a similar process on something else. Okay. So again, practice with real world companies, trying to do some explanation and stuff. Right. All right. So again, I posted that file and those screenshots to Canvas. They are available under the file section. Under here, which is the homework 3 solution, and then under the September 24th lab assignment screenshots are there. All right, and there's the lab assignment Excel file. So today, we're going to start going through lecture 4. And what I want to start giving us some insight into is, once we convert the economic statements, then we're going to use the converted statements to help us with our analysis and understanding of the companies that we are focusing on. So this is a conversion for a company called AECOM. AECOM is based in Los Angeles. They were put together through a series of mergers and acquisitions, but they're one of the leading construction engineering firms in the world today. So in their language, if you're doing vertical construction of complex things, complex buildings, they're one of the few people that you call if you have a very high-end building that you want built, or a complex building. So for example, they built the Barclays Center in New York. They did the new World Trade Center Spire in New York. Like, those are 2 of their premier properties that they just finished. But they're global. They do stuff all around the world. So I'm just saying, very big, complex engineering buildings, they're one of the few companies that do it. So I wanted to look at their historical financial performance using our cash flow format. So basically, here's the CFI for AECOM, excuse me, over a historical 5-year period of time. By the way, here's a great midterm question. How many years of income statements and balance sheets did I need to create 5 years of CFI? 6. Okay, so we would have gotten 6 years worth of statements, created these 5 years worth of CFI. Now the only other thing is I added here a total column where I literally just summed the 5 years across. Okay? And then percentage of gross cash flow. Got some ratios here. So when we do our analysis after the midterm of companies, you will create for the companies that you've been assigned a statement that looks like this for every one of those companies, because it will basically help us understand the past of the companies that we're looking at. So for AECOM, I'll start out with, when we do CFI, there's 4 sections of CFI. There's the operating section, the non-operating section, the debt, and the equity. Those are the 4 sections that we have to explain what is happening with a company. So I'll start out with the operating section. The operating section is free cash flow. Over a 5-year period, AECOM generated gross cash flow of $1.3 billion, $1.3334 billion to be exact. Now, you'll notice that I'll refer to numbers when I go through the analysis. In this class, you must refer to a number when you're giving your assessment. If you just say their cash flow is getting bigger, I have no idea what you're talking about in your answer because there's a lot of cash flows on this page. So therefore, in order to get a correct answer, the TAs will grade you in the same way, is that basically you must also refer to what numbers you're talking about so we know that you're actually referring to the right number, right? So always in this class, refer to numbers when you're making your assessments. And you'll notice I'm doing that as I go the way through. So again, gross cash flow, $1.3 billion. Now, gross investment also was $1.3 billion. So basically, they ended up with free cash flow of negative $22 million. So their reinvestment rate was 101.6%. Okay, so we have a company over a 5-year period of time that took all of its cash profit and poured it right back into the operations of the business. That's the first thing that we know about AECOM. Now, if we start thinking about growth opportunities, this is a company that probably sees some growth opportunities. Otherwise, why would they put all of their free cash flow back into their business? Okay, so what they did is they put back all the cash flow back into their business. So here's the other thing. In addition, they spent another $1.6 billion on acquisition premiums. I mentioned they did a bunch of M&As. So after acquisition premiums, their free cash flow was $1.6 billion negative. So another way of thinking this is for every dollar of gross cash flow, they spent over $2 in total investment per every dollar of gross cash flow over the 5 years. And most of it actually came through acquisition. So here's the point about free cash flow. Our definition of free cash flow that we're using from the McKinsey book includes spending on M&A. Not all definitions of free cash flow do that outside of this class. Matter of fact, the most common definition that you'll see for free cash flow is gross cash flow minus capital expenditures. And they'll ignore changes in goodwill. But AECOM's a good example of why you shouldn't ignore changes in, they'll ignore changes in working capital. AECOM's a good example of why you should not ignore changes in working capital because they actually spent more on working capital than they did on capital expenditures. All right? So CapEx and working capital matter when we think about free cash flow. Think about reinvestments. But here's the other argument that McKinsey makes, which I agree with, which is the whole point about gross investment is it's the money that I'm spending to basically support my operations, right? Because I'm going to use these assets to operate them to generate more sales in the future. Well, if I build a manufacturing plant from scratch, it's obviously going to be operating because I'm going to use the manufacturing plant to make products I sell to my customers. If I buy somebody else's manufacturing plant that I then run to make products that I sell to my customers, is there really any difference than if I built it myself? I mean, it's probably going to be more expensive to buy somebody else's manufacturing plant rather than building it myself. But in either case, I'm using it for an operating activity. Therefore, acquisitions, when you buy another company to run that company, that's operating. When you buy a piece of that company and you let that company run itself, that's non-operating. That's the equity investments. But the key point is M&A is operating. Now, here's the thing about M&A accounting. If I buy another company, I absorb all their assets into my assets. I literally combine them together. But the difference, the premium that I pay, is called goodwill. Okay? So basically, the amount that we recognize on the free cash flow is not the total amount of the M&A, but what we recognize is the goodwill premium. So it's the extra amount of money that was spent to acquire that asset by buying it at a premium, and that's going to be reducing our free cash flow. So basically, that's what the investment in goodwill and intangible line represents. It's the goodwill premium for the acquisitions that they have made. So the actual amount they spent on M&A was higher than that, This is just to pay for the premiums. So 3 things go into gross investment. Spending on working capital, spending on net PP&E, called CapEx, and then spending on intangible premiums, specifically goodwill premiums. And that's where they spent the $1.6 billion. So their overall reinvestment rate was like 223%. Okay. So negative $1.6 billion of operating free cash flow. Most of it negative in the last 2 years, almost $1 billion in 2010, 2011. Now, we then go to the non-operating section. We're trying to get to CFI, which was negative $1.8 billion. Operating cash flows were negative $1.6 billion, so I know that I used money in non-operating activities, a couple $100 million. So what caused me to spend a couple $100 million of non-operating cash flow? For AECOM, the biggest item of non-operating cash flow expenditure was something called excess cash. They spent $236.8 million increasing their excess cash balance. Now, this is something that the book talks about. The book talks about the concept of operating cash and excess cash. And this is why you can't use like Investopedia in this class, right? Because if you use Investopedia in this class or your accounting knowledge, you will get an incorrect answer. Because the definition of working capital in, for example, Investopedia is current assets minus current liabilities. And in our class, current assets are not the current assets we're going to use for working capital because we're going to take anything out that's called non-operating. Excess cash is non-operating. Current liabilities, same thing. We're going to take out non-operating and we're going to take out anything that interest bearing. So short-term debt or current portion of long-term debt, not part of working capital in this class, is part of working capital in your accounting class. So here's the point. Excess cash is different than operating cash. And this is the example I gave to the previous class. So when I was in high school, I worked Burger King drive-thru. It's one of my jobs. And what would happen is that I'd come in to do my drive-thru shift. The assistant manager would bring me to the back of the store. He'd pull a till out of for the cash register out of the safe. And in that till would be $120. Exactly, $120. And then what would happen is he'd walk with me to the cash register. He'd take the till out of the cash register, put the till in the cash register, hit a couple buttons on the register. I would start my shift. At the end of my shift, he'd come to my register. He'd print out the receipt. He'd take the till into the back. We'd count out $120, leave that in the till. Everything else above that was taken out and then kept for the store. And that was my introduction to operating cash versus excess cash. So this was back early 1980s when I was working at BK. So a long time ago, before people paid credit cards at the drive-thru, it was all cash. But that was the point. We needed cash in the register to make change. And we always needed a certain amount. That was the $120. And we always kept at least $120 to make change. And no matter who was running the drive-thru, you always had to have some cash in there to make change, which meant that cash could never be used to make payroll. It could never be used to buy inventory. It was never used to pay rent on the store. It always had to make change. Operating cash. There is some cash that a business has that cannot be paid out. Right? That's operating cash. Then there's the cash that can be paid out, the amount above the 120. That's excess cash. We are going to discriminate between those two things. And that's something we're going to have to assess when we look at a business. Now, for your midterm exam and for your homework assignments, I'm going to tell you what the operating cash is, and I'm going to tell you what the excess cash is. You don't have to figure it out. But post-midterm, when we look at companies, we're going to have to assess how much of the cash is operating, how much of the cash is excess. As a matter of fact, one of the terms you'll probably learn in another class is something called net debt, which is you take the debt minus the cash. Except that's a fallacy because the net debt is never a real number. Because if the company ever went bankrupt, it could never use all of its cash to pay off the debt. The lawyers would take some of the money. The government would take some of the money for unpaid taxes. The employees would get some payroll. Some of the vendors would get paid before the banks and the bondholders got paid. So I know Wall Street likes to use net debt. I know the finance professors like to use net debt. But no one in the real world could actually pay out the net debt because you would have to use some cash to pay some of the other parts of the business. Operating cash. So cash is not fully distributable. Matter of fact, when General Motors went bankrupt with $10 billion worth of cash because they said $10 billion was the line when we stopped functioning at General Motors. It wasn't zero. So they essentially told you what their operating cash balance was if you actually read the headlines, because they said 10 billion is the number where we go bankrupt. And to the average person, that number is inconceivable. They're like, how could you go bankrupt with $10 billion worth of cash? But the answer is, when you're a global enterprise that's $160 billion with people in all sorts of countries and vendors that are constantly being paid around the world, you can't operate a business on zero cash. So long story short, here's the metaphor that will help you with your CFI analysis that will help you interpret this. I want you to think as operating cash like a checking account. And we pay bills out of our checking account. And I want you to think of excess cash as like a savings account. And we can't pay our bills out of our savings account. So when we take money from our checking and we send it to savings, what we're doing is we're reducing the amount of cash that can pay our bills. Therefore, we're reducing our CFI. So basically, that's what's happening here with AECOM. They took $236.8 million of checking and they moved it into savings, reducing their CFI. Yes, sir.
Wait, but earlier you used the analogy of the till and like the $100 times $20 and everything else being in excess, but isn't that also some of that is also operational to pay your wage and stuff?
Yes. So I'm mixing metaphors here. But when I took the Burger King money and they took it out of the till, they're actually using some of this for the operations cash flow. And then the point is, well, let's just keep it simple. Let's say I had $1,000 of excess cash that came out of the till. And then I actually spent $900 on expenses, working capital, and CapEx. So there's $100 left. Then what do I do with the $100? This is truly the excess cash. So then do I either pay it out to my investor, or if I decide to just keep it in the bank, then I increase my excess cash by that $100. So you're right, it's going to be a net of that amount. But back to that analogy, if I draw down my excess cash reserves, put it in my checking, then basically it makes more CFI available. So it's really, what do I do with this sort of discretionary excess cash that I have to solve for? So what they did is they increased their excess cash, meaning they needed $1.8 billion from investors. So the next question becomes, in 3 and the 4s, the debt and the equity, where did the cash come from? Well, debt. What happened on the debt? They paid $47.2 million worth of interest. They borrowed $1 billion of new debt, which makes sense. They had to go fund the negative cash flow here. They also increased their pension liability, retirement-related expense. So basically, they owed money to their employees, and they didn't fund it. So they used that cash to help them run the business. They also had some minority stakes in other business. So off the income statement, they paid a minority cash distribution to those minority shareholders. But off the balance sheet, they actually make new investments in additional minority stakes. So the balance sheet minority interest is basically the opposite of somebody else's equity investment. It's what I owe the minority shareholder that I've separated out their portion of the assets, right? So it's the asset that I owe is a liability to me. It's actually called equity. So it's kind of like a quasi-liability that sits on the 3 and 4 border for the minority stake. So that's what I owe, the cumulative amount invested. And then the other part is what I distribute every year is the income statement distribution to those shareholders. It's a dividend. So they actually paid $64.7 million of dividends to the minority shareholders, but they actually increased the amount of money that their minorities investors had in them by $37 million. The other thing, they really didn't pay dividends. So they issued some shares. They issued $300 million worth of stock. They also had something called an AOCI adjustment of $823 million. Now here's the thing. AOCI, the other adjustments to equity, are a catch-all that we have to go and look and see what's actually happening on the balance sheet by looking at the footnotes. By have working with AECOM in the past, basically what that came from is their acquisitions. When they bought some of these companies, they paid both cash and stock. So this represents some of the stock that was issued as part of the acquisitions that they were buying. Now what's interesting is they also directly issued some shares to the common shareholders while buying back shares. So they bought back $419 million worth of stock. They issued $317 million worth of stock. All right? But if you look at the actual cash flow of AECOM, what you can see is they really couldn't afford to buy back the stock. That they had negative CFI, and it was negative for 4 of the 5 years, and they never had enough cash to buy back that stock. So what they really did is they borrowed money, either by issuing new shares and or issuing new debt to buy back the stock. Right? So what they were trying to do is take advantage of low interest to basically fund the debt cheaply, to change their capital structure, and they were taking advantage of a depressed stock price to basically look like they had confidence in the company by buying back their shares and reducing the shares outstanding. But I'm telling you, a sophisticated financial person would recognize that I don't really care about the share buyback. What I really care about at AECOM is all this investment and whether or not it's going to pay off in the future. Because that's really what's going to matter to the cash flows. It's the $1.6 billion they spent on acquisition premiums that basically was more than 100% of their gross cash flow, and the fact that they reinvested all their gross cash flow into capital expenditures and working capital. It's the returns on that that are going to matter much more to their stock price in the future. But nonetheless, this starts to give us a picture of what's happening to the firm broken up by this statement. The other analysis that we're going to have to do, and there's some industry comparative data in the next couple slides, is we're going to have to create these things called ROIC trees. As a matter of fact, that's going to be the Bloomberg Lab assignment on Wednesday. You're going to create an ROIC tree using Bloomberg data for another real-world company and analyze it. So when you create a tree, you're going to create a tree that looks something like this. And EOY is something that stands for end of year, right? As opposed to BOI, which would be beginning of year. Now, end of year basically means if I do a 2007 end of year ROIC, I use my 2007 NOPLAT divided by 2007 invested capital. So as opposed to an average or a starting invested capital. So it's basically using the end of year numbers. Keeps it simple for your analysis. So here's the thing. When we do an ROIC tree, we're trying to explain the changes in ROIC over time that a company is experiencing. Specifically, we're going to be looking at a 5-year period. So in 2007, AECOM's ROIC was 10.4%. 2011, 8.4%. Now this is the operating ROIC calculated using converted statements. Right? This is not the Bloomberg ROIC. Right? So their ROIC went down by 2 percentage points, 200 basis points over this 5-year period. The next question is why? Why did that ROIC go down? There are always 3 reasons that answer that question. There are 3 things that determine your change in ROIC. They're on the tree. Number 1, tax rate. Number 2, operating margin. Number 3, productivity. It will be some combination of those 3 things that will determine the change in ROIC for any company. So we'll start out by looking at the tax rate. First, we're going to calculate the cash tax rate or the effective tax rate that the company is actually paying. Right? So in this case, in 2007, AECOM's tax rate was 28.8%. In 2011, the tax rate was 26.1%. Should that have helped or hurt their ROIC? Should have helped. So taxes are not the reason why their ROIC is falling. All right? But that's what first thing we want to look at. What did the taxes do to the ROIC? All right? So was it the taxes that caused the ROIC to go up? No. Was it taxes that caused the ROIC to go down? No. All right? So in this case, very specifically, the taxes should have caused the ROIC to go up. Right? Should have helped the ROIC. So that's not why the ROIC went down for AECOM. So then we look at the pre-tax ROIC. The pre-tax ROIC takes out the taxes, and it just looks at the pre-tax profit. And we can see that this is the performance of the operations of the business. Their operating performance went from 14.6 pre-tax to 11.4. Right? So on a pre-tax basis, they're now earning a lower rate of return than when they started. So this is where the ROIC went down. Now, two drivers of pre-tax ROIC. Margin, cycle time, also known as productivity. We talked about that last week. So, starting out with margin. Operating margin is the EBIT margin. EBIT divided by sales. Operating margin went from 3.4% to 4.7%. Would that have helped or hurt the ROIC? Should have helped. They're more profitable. Now they're making 4.7 cents in every dollar of revenue. They were making 3.4 cents of profit in every dollar of revenue from operations. So they're more profitable. Well, that's not why the ROIC is going down. So I can tell you through process of elimination, if there's three things that affect ROIC and two of them improved it, it's got to be the third. Productivity. Invested capital divided by sales times 365 equals cycle time. This chart just doesn't multiply by 365. So it's just invested capital divided by sales. So basically, margin times productivity equals pre-tax ROIC. Or specifically, margin times 1 over this number equals that number. So these two have equal weight. Here's how to think about productivity. The way to read it on this chart. In 2007, to generate $1 of revenue, they invested capital, 23.2 cents. To generate the same dollar of revenue in 2011, they invested 41.1 cents. Is that better or worse? It's much worse. They're spending almost twice as much to generate the same revenue. That's what we're clearly seeing here. All right. So really, if you want to think about the story of AECOM, it's the story of lost productivity. It's not the margins. Their margins are actually improving over time. It's their productivity that's worsening. Yes, sir.
So will you also just be giving us these, like the operating margin, or will you be giving us like EBIT and sales?
I'm going to give you a ticker symbol, and then you're going to go get all the raw data from Bloomberg. So Bloomberg will give you the EBIT. Bloomberg will give you the sales. Bloomberg will give you the components of invested capital that you will add up and calculate. Bloomberg will give you the taxes paid. So you'll get all the raw components, and you'll create the tree. Yes?
What he meant was like, what is the other test?
Oh, on the test, I would have given you an already calculated tree.
Okay.
But I will tell you, on Wednesday's exam, there will be a tree, and you will have to make some analysis based on the numbers on the tree, just as we're going through it right now. That'll be part B of the midterm. Right? So, this is what I'll call the first level of analysis. Right? So it's understanding how these three things drive overall ROIC. Then we're going to do a second level of analysis. The second level of analysis is the next layer of the tree, and what it's going to do is it's going to explain what's happening to operating margin, and we're going to explain what's happening to productivity. So I'll start out with operating margin. If operating margin is EBIT divided by sales, there are three things that create EBIT. One is our gross margin, minus our SG&A, minus our depreciation, equals operating margin. All right? That's just accounting 101. So from the accounting statement, gross margin minus SG&A minus depreciation equals operating margin. So we're trying to understand is why is the operating margin improving? Well, first, gross margin, we can clearly see, went from 5.7 to 7.2. This is the difference between the price and the cost of goods sold. So getting better pricing power relative to their cost. That's helping them. 2 cents from gross margin. It's more like a penny and a half. SG&A, 1.3 cents, 1.1 cent. Actually spending slightly less on SG&A, but it's still about a penny. Depreciation, 1.1 cent of depreciation versus 1.4 cents. That's hurting them slightly, but again, it's still about a penny. The primary reason that their operating margin went up was because they're getting better gross margins on their sales. That's why the operating margin is going up. Looking at the productivity side of the equation, three major buckets of invested capital. Number one, operating working capital. OpWC. Number 2, net PP&E. Number 3, spending on intangibles. Working capital plus PP&E plus intangibles equals invested capital divided by sales. So these 3 things add up to that. Right? So as I think about why is my invested capital to sales getting higher and therefore worse? First, working capital. I was spending 6.5 cents out of every dollar on working capital. Now I'm spending 11 cents. So I'm spending an extra 5 cents on working capital per dollar of revenue. For PP&E, I was spending 2.8 cents. Now I'm spending 4 cents. Spending an extra penny on PP&E. Intangibles over sales. I was spending 14 cents. Now I'm spending 26 cents. I'm spending 12 cents more on acquisition premiums than I did 5 years ago. So if you really want to look at where is AECOM's productivity taking a hit, it's primarily through their acquisitions. They're spending a lot of money on acquisition premiums, 12 cents in every dollar, and they're spending an extra 5 cents in every dollar on working capital. So if you really want to understand the AECOM story, those are the 2 things that are driving the story. Slightly better operating margins based on better gross margin, but that's more than being offset by how much they're spending on working capital and how much they're spending for acquisition premiums. And that's hurting their overall ROIC. So that's what we need to do with what I'll call the first and the second level of analysis. If you really want to be in the bonus round territory right now, you could do a third level of analysis and look at the drivers of working capital. Inventory, payables, receivables. But that's not going to be necessary for the midterm. Right? But nonetheless, in other classes, they'll talk about sort of the working capital cash cycle. That's some of the key components of working capital cash cycle. What I'm just more concerned with right now is that we understand that if we spend more on working capital, it's going to reduce our free cash flow. Right? And we could see the spending, by the way, on the CFI. There's all of the spending here, in particular, in the working capital line, the $740 million, which is much higher than the capital expenditures, and the $1.6 billion spending on goodwill and intangibles, showing up on the tree here and here. All right? Now, the one thing that the tree does is the tree puts everything in relation to sales. So that's the point. I could be spending more, but if my sales are growing, then spending more isn't necessarily a bad thing. The problem is they're spending a whole lot more relative to the sales growth, and that's what's making them less productive. Now, the company might argue, well, gee, we just did a bunch of acquisitions, we just spent all this money, it hasn't paid off yet. So then we'd have to make an assessment about the future to say, is this stuff really not paying off and going to pay off in the future, or is the company just kind of hoping that things will work out and things are bust? Right? And that's why we'd have to make a separate assessment about the future. But right now, what we've done is we've got a better understanding of the past, so we're better prepared to engage with the company to figure out what's happening with the future. So by putting things in this format, it helps us, before we even know anything about this company, it helps us kind of go in knowing a lot about the company. And it frames the types of questions that the analysts will ask. Questions about any of this? Okay. All right. So those are the 2 types of analysis we're going to do a lot of the second half of the semester. You'll be creating these yourselves. You'll start practicing on the tree on Wednesday. Right? Now again, for the midterm, you won't create the tree on the midterm. You'll just analyze trees on the midterm. You'll analyze CFIs in the midterm. We're going to do a lecture on Wednesday where we go into this in a little bit more detail. But if you have any questions, now's a good time to ask before you get to the midterm. Because once we get to midterm week, the TAs and I can't help you. Right? So you have to ask us before then as you're working on these assignments. But you get some practice on this on Wednesday. All right, the other thing I want to cover in class today is back to, on Canvas, there's a file called miningbench.pdf. And this is a version of a file that I created for Rio Tinto. So remember I went to Australia? These slides were used in my Australia presentation to Rio Tinto. I did a little bit of benchmarking on the global mining industry. Now, it's not all the presentation because I took out all the proprietary stuff, but this is all the publicly available data that you could be able to create yourselves, and will be in the next few weeks. So here's how we're going to do this. I'm going to ask you to break into teams of 2 or 3. This is not a graded assignment right now, but given these ratios on this table, I want you to analyze a peer and an industry. Okay, so just to give you a sense of this, here is 6 years worth of historical data on the after-tax profitability. So think of this as no plat divided by sales for 4 of the 5 largest mining companies in the world. So Rio Tinto, which is about a $75 billion company, BHP Billiton, which is about a $90 billion mining company, Freeport-McMoRan, which is actually based in Scottsdale, Arizona. They're the largest copper miner in the world. And Anglo American is another British company. And then the only one that's not on here is a Brazilian company called Vale, because they're primarily owned by Brazil and their numbers don't make any sense. Because Brazil is allowing Vale to try and become as big as these other miners, and they're in heavy investment, don't care about making money mode. So as an individual investor, you would never invest in this company because their numbers look horrific. But the Brazilian government doesn't care. They're subsidizing this company until it becomes global scale to compete with these other miners. So I've left Vale off the list. But nonetheless, these are 4 of the 5 largest mining companies in the world. So their primary business is they dig iron ore out of the ground, sell it to the steel mills, sell it to the auto companies, right? Aluminum, iron, copper, the core basic materials, diamonds, platinum, all that stuff, gold. That's what these guys do. They dig it out of the ground. So here's the point. I got 6 years worth of data, and I got the ratios that we've been talking about this semester. What I want you to do is I want you to analyze very quickly. We don't have a lot of time here in class today. I want you to analyze very quickly. Rio Tinto is the company that we're all going to represent. So we're going to take Rio Tinto's point of view, and we're going to compare ourselves. The peer is BHP Billiton. BHP Billiton is the largest mining company in the world, so we're going to just do a quick comparison between Rio and BHP. And the industry is Rio against these 4 miners. It's the average. Okay, so to keep it simple, we're going to use this arbitrary 5-point scale. If we're doing better on that ratio than the peers or the industry, call it a 4 or 5. If we're doing worse than the peer or the industry, call it a 1 or a 2. And if we're doing about the same, call it a 3. All right, just so we can quickly do this assessment. So I want you to go through. You can work in small teams if you want. It's not a graded assignment. Quickly score and assess the industry on that 5-point scale and the peers, Rio against BHP, Rio against the 4 industry companies. How are they doing? And here's the thing. You're not doing it for 2013. You're kind of looking at a 6-year trend. So do it over a 6-year performance look. Right? That's the first assessment I want you to do. And then I just want you to give me an overall perspective of what do you think about the mining industry in general and its performance over time. We'll talk about this in about 15 minutes.